All right, welcome to the Trader Tuesday. Today's the 11th of June, 2024, and a special guest and good friend, Luc Van Hof. Now, my wife, Gabby, is from Belgium, grew up in Antwerp, a native Flemish or Dutch speaker, and we spent a lot of time in Belgium. We actually lived there for a year. And Luc is also a Belgium citizen, lives a little bit away from Antwerp, but not too far. But we met through some trading avenues, and Luke's been a very good friend, a really interesting background, and really glad to have you here, Luke. Looking forward to it.
My pleasure. Hi, Tom. So, what would you like me to talk about? Because there's a
Well,
lot I
just
could cover.
yeah, just kind of how you got started in it all. What'd you do? I think you were on the floor of an exchange and flew to Chicago, once a month.
Yeah.
Really interesting stuff. So,
Okay. Well, let me start with that. So I'll give the quick story about what I've been doing before and what I'm doing now. So basically, going back a long time, because I've been trading for quite a long time. I started trading in 1985. So that's indeed a long time ago, I think. And I joined back then the European Commission, where I was the assistant treasurer. And I had to manage a portfolio together with two other people, which was quite significant. It was about 2 billion ECU, which was the predecessor of the euro, about the same exchange rate to the dollar. That's what we are seeing now. And it was basically the result of all the taxes and levies that the European Commission has collected from the member states. And so in the Treasury Department, we had to try and manage that portfolio in a very conservative way. And as a result, we used mainly government bonds. It could be dollar denominated, Deutschmark back then, Italian lira, drachma, so all the currencies from the European Union. And so that's what I've been doing for quite a while. Then, as we had to try and increase the return from that portfolio, but at the same time, we had to keep it very risk averse. We tried different features, and I was in charge of the dollar and the yen book. And so the friendly people from JP Morgan, Goldman, Bankers Trust, Morgan Stanley, all these people, they of course wanted to trade with us because we had a pretty significant portfolio to manage. And the smallest ticket we could write was like 25 million equivalent, so about 25 million US dollars. So they came up with all kind of strategies, tactics to try and increase the return on the portfolio. And of course, that's how I came to know or got to know derivatives. So we started with swaps, with options, with futures, and we basically added that to the portfolio of government bonds. And one of the banks that I used to work with a lot, Bankers Trust, basically hired me away from the European Commission, and I went to work for them on their derivatives trading desk in London. That was BTI, Bankers Trust International. So I did that for a couple of years, and then actually was hired by Morgan Stanley to become a prop trader. So as a prop trader, in essence, what you need to do is to manage the money of the firm. In this case, Morgan Stanley was back then, this is in the early 90s, still a privately held company. So not a public company as it is currently, of course. And so the partners' money had to be managed according to different rules and schedules that they have come up with. In essence, it boiled down to 7 people. We were a team of 7 people, prop traders, and they each had 1/7 of the partners' money, so to speak, that we had to manage and mainly try to get a decent risk-adjusted return. So each of us has his or her own specialty. It could be in individual equities, could be in bonds, could be in derivatives. Mine was short-term trading using derivatives. And that's what I did at Morgan Stanley. So after a couple of years, I said, well, why would I continue doing that if I could actually do it also for myself or for a couple of clients? So I set up my own company a couple of years later, so in the early 90s, mid 90s. And I started with AIM, which is the abbreviations for Analytic Investment Management, which was a regulated investment management company here in Belgium. And I started managing money for institutional clients. And so I built my own trading systems, but kept specializing on the S&P. So on S&P, and that's actually what I'm still doing today. So I traded S&P, back then S&P, SPX, and OEX. So mainly options and also futures on the S&P index, which were back then the big contract, not the E-mini S&P, but the larger form of it. And so doing that, it went rather well, I should say. And by 2005, one of the banks in the Netherlands, Robeco, part of Rabobank, came knocking on the door and wanted to take a stake in my company. And ultimately, by 2010, they basically had bought my company. So I sold AIM Analytic Investment Management to Robeco when I had about 500 million under management. And so then I said, well, shall I retire? Shall I do something else? But of course, as I say, I got the needle in pretty deeply. So I'm really very much, how shall I say, passionate by what's happening in the market, by research and trading the markets, especially then stock index markets. And I continued with Capital Hedge, which was like a small version of analytic investment management. And I basically consulted for institutional clients. And I started a couple of funds. So mainly focused again on index trading, on options trading. And now recently, my son, my oldest son, who is also in the business, pitched me and basically convinced me to launch a new fund, which we will be opening up and which has started in the meantime to basically make our strategies available to the public. And so it took about a year and a half before everything was signed and sealed. And we launched the fund about 2 weeks ago on the 22nd of May, actually. And so this is a fund where we combine some of the more robust strategies that I've developed over the years with the team I had. And so we're trading basically, again, S&P, S&P, and S&P. So it's a very focused strategy. We use options, we use futures, we use options on futures, but it always boils down to trying to find some kind of an edge in the market. And so basically, what are we doing in terms of methodology? Well, I could summarize it by saying, well, we are doing some directional trading on the one hand, and some non-directional trading on the other side. So the non-directional trading is pretty straightforward. It's using options pretty long-term. What I call long-term is between like 3 months and 6 months. Most of the time, occasionally we go out to like 12 months, but most of the positions, most of the options that we use are like in that time frame between 3 and 6 months. Now, we are not holding these positions for very long, probably like 10 days up to 30 days, and then we take them off the books, but they're all delta neutral strategies. Usually we try to be long gamma, long vega, but in essence, we start off with a delta neutral book, and we don't really let it fluctuate too heavily into one side or the other, and then adjust, of course. Now, that non-directional trading is very, what I call low maintenance. So we put the trade on, watch it on a daily basis, and do occasionally some adjustments. Maybe there are 3 to 5 adjustments during the life of a trade. So it's very easy to track, easy to trade, and it's generating a pretty decent return. So like in the high single digits to low double digits, say I should say between 5 and 15%, with a pretty low drawdown, because everything that we do is what I would call systematic trading. So there is not a single thing that I do which is not using a system. So we've developed trading strategies, trading systems over the years, over the last 30 plus years. And we've come up with a pretty dense library of about 200 different strategies. Some of them, they don't really hold up very long, as you might have experienced. Some strategies, they work fine in a certain environment, and they don't, or they come back and then they go away. So it's not something stable. So we need something very robust. And of the, say, 200 plus strategies that I've developed over the years, we have like about a dozen, maybe slightly more, that are truly robust. Robust in the sense that they work across most markets and in most market environments, across most market regimes, as they call it. And that's why I've collected, say, the top 10, so to speak, of these systematic investment strategies, and which are all developed in-house, based on in-house research, and I think really proprietary and probably unique Of course, someone else could have had the exact same idea. I don't know, but it's not something which is publicly available. It's something that I've developed over the years and tested and traded for a very long time. And that's basically that we bundle together into the Enigma fund. And that fund is the one we just started, is basically the continuation of what I've been doing for the last, say, 10 years. And in order to help the fund get started pretty quickly, we asked an outside company, a third party, to look at all the trades that we've done over the last 10 years. And these were about 4,000 trades. And they made a pretty detailed report about the trading, came up with 60 to 80 pages of statistics and analysis compared to all kinds of indexes and other strategies. And so that's what we basically used when we pitched our fund to investors. And now it's just started. It's an 8-figure fund, so it's pretty decent in terms of size. And we trade, apart from these options that I already explained, we also use some what I call directional trading strategies. And of course, the directional trading strategy is basically trying to pick a side, pick a direction, and go with the flow. And this could be using different algos, different tactics. But in a nutshell, we could say, well, there are some trend following strategies within that group of 10. There are some mean reverting strategies. There are some pattern recognition strategies. So these 3 groups, they're all the time, I should say, on high alert to get ready to get into a trade. And what will happen is most of the time, some of them are long, others are going short. So we have like a net position that could be net long or net short, but sometimes we are basically flat in the sense that we enter into a trade, say, this morning we went long, for example. We had a long trade around 51. We got out of the trade around 61, and we traded back and forth a couple of times. And that's due to the fact that some strategies kicked in from the long side, others kicked in from the short side. They each have their stops. They each have their own exit strategies. So when to take profits, when to abandon the trade when it's a losing proposition, and so on. So, but all in all, it boils down to having a bundle of strategies that combine, I should say, nicely, and they basically take away all the, what I would call irrational decision making, all the emotions. So it's making it easier for me to avoid making investment mistakes. In other words, when the system says go long, it's not because I looked at the chart and say, well, I think I should go long here because of this A, B, or C. No, it's because a certain strategy fires signal and I just implement it using either options or futures. So it's basically an automated strategy, an automated investment style, but what I would call under human validation. So I still have to verify if it really makes sense. If the market is, say, now at 53, 55, as we speak, and it would fire a signal that says buy the market at 6,000, something must be wrong in the code. And it's a very long code, so there could always be an error that we haven't come across yet, but it's always possible. That's why we don't use APIs. We don't have the trading automated to the extent that we don't need to intervene. We always have to verify if a signal makes sense. And that's why all the strategies have been coded in such a way that they also generate a visual output so that we know, okay, this makes sense. These indicators or these patterns are indeed available and are firing off. So it's like giving the green light before you enter into a trade. But we have to confirm it manually on the trading platform before we basically enter into the system. So it's a bundle of a combination of about 10 different strategies that each have their own advantages and disadvantages. Some are going short now when the market is rallying. Others are going long when the market could be falling. But all in all, they have a pretty nice equilibrium, I should call it, a nice balance between mean reverting systems, trend following systems, and pattern recognition. And bottom line is, in fact, it boils down around key areas of support and resistance. And it's very simple. The code is not complex in the sense that it uses hundreds of different parameters or dozens of different configurations. It's pretty simple in in terms of its trading logic, I think the sophistication, so to speak, lies more in what I would call the risk management. So the money management, how to determine the trade sizing, when to scale in, when to scale out, things like that. And I think that's the key for generating a decent return. And so that's what I've been doing for many years, and that I hopefully will try to continue for a long time, because it's really
You had an
fun.
interesting story about having to travel to Chicago every month. I think you were on the floor in London, I think it
Oh yeah,
was.
oh yeah. That was my time when I was with Morgan Stanley. So on a regular basis, I had to go to Chicago, especially during Gamma Week, so the week of the expiration, because back then was only the third Friday of the month that we had the option expirations. We didn't have weekly options, let alone zero DTE options. So it was really like the tricky week of the month that things could really move quite a bit. And so that week of the month I spent usually in Chicago. So that was the main reason why I had to go there, because communication back then in those days with Zoom or Teams or something didn't really exist. There was
Right.
some way to do some video communication, but it was not really very efficient nor effective. So we really had to fly back and forth a couple of times just to be on the floor and watch the market from nearby instead of doing this from a distance. So that's how I visited the States quite a bit, quite frequently. But these were always short trips, I should say.
Right. So I know you mentioned that your systems are very focused on risk. So how have you developed your approach to risk over time? Has it changed, or has it keep getting different, or can you talk
Yeah,
about that a little bit?
that's a very good question, because if I would say make a distinction between the entry rules and the exit rules, the entry rules have not changed. Not, I think, in the last 10 years, probably they haven't changed, or maybe a small modification, a slight tweak or whatever, but nothing substantial or significant. While on the exit side, and even more importantly, on the trade management side, so the trade sizing and the trade management, there has been quite an evolution. And that has to do with the fact that instruments have come along that were not available previously, like these weekly options, like these zero DTE options. And that's how basically the money management and the risk management has changed. So one example is, instead of doing futures, to basically implement a trading strategy that is, let's say, mean reverting. And what is typical with mean reverting strategies is that they really go against the grain. So in other words, the market makes a dip, falls out of bed, and then that system may say, well, we should go long. It's a very tough thing to do. First of all, buying when the market is falling, it's like trying to catch a falling knife, as I say. But at the same time, it's even more difficult to determine, at least for me, to determine an appropriate exit level, because the market is basically falling, is going down. You don't know how far it's going, but still the market, the strategy is giving you a signal to go long. So it's a very tough thing. And most of these mean reverting systems, they work better without an effective stop loss. In other words, if you use a stop loss, if it's 10 points away or 5 points away or 50 points away, it's not improving the system on a risk-adjusted basis. So in other words, the best solution would be to not use a stop, which of course is scary, because if the market gaps down 100 points or goes limit down or whatever, things can happen, could be pretty dramatic. So one of the things that I've done over the years is, of course, gradually replaced the implementation of the strategy with options. In other words, instead of using the futures and be long futures, come up with a strategy that basically gets the same kind of delta exposure, but with an embedded maximum risk. So that's one of the key things that helps in fine-tuning the risk management. Now, on a higher level, what I start to do with is what I call maximum exposure per trade. So it's so-called mixed definition. So you decide on a maximum exposure per trade, and that's basically a function of the maximum exposure you want to accept in terms of the time frame of your choosing. For example, if you say, well, on a monthly basis, I don't want to lose more than, say, 5%. That's like my maximum risk on a monthly basis. In that case, of course, I need to take the necessary steps and make the necessary arrangements that I'm not going to have a day where I'm down 6% or more than 5%. So it boils down from a maximum exposure per month or per year, if you want, to a smaller time frame. So a maximum exposure per week, so that in order to avoid having a loss for the month, which is bigger than, say, 5%, you have to make sure that you don't have a single week, which is more than 5%, because then if that happens, you have to be basically sure that you're going to make up for that, which you cannot be sure that that's going to be happening. So you have to avoid on the smaller time frames fractions of that initial bigger risk. In other words, if you say, let's assume there are 5 weeks in a month, just for simplicity's sake, well, every week you can only have a fifth of what is the maximum limit for the month, the maximum risk limit. And it boils down to the daily limit. And then from there on, it boils down to the trade limit. So the max is like the smallest level. So the maximum exposure per trade, which will determine what is the maximum market exposure I will have with one specific trade, which of course also embeds a certain maximum risk per trade. So it could be, like in my case, 0.1 or 0.2% of the account value. So if I put a trade on, I'm sure from the start that whatever happens, even if the market stops, is being halted or whatever, I will never lose more than, say, the 0.2%. Why is that? Because I use some option strategy together with the trade, which could be starting with futures. But say, for simplicity's sake, let's assume I simply go long futures. I will buy a put option that will cover the position in case the market really crashes dramatically. And that would avoid basically that if I would have a simple stop loss with a long futures position and the market goes, for example, let's assume 5 minutes before the close today, I would get a long signal in the S&P. So I buy the market, and imagine I would buy futures. Well, I'll have a stop loss with the trade, which could be, say, 10 points lower or 20 points lower or whatever. But it doesn't help me. It doesn't guarantee me anything. Why not? Because the market may gap down for whatever reason, 25 points or even 50 points. And then my stop, of course, is becoming a market order. So what I will do, instead of having this guaranteed or this protective mechanism using a stop loss, using futures, I will have options to basically protect the position. Another simple way to avoid the scenario is to simply do a combination with options, which has the same delta exposure as you would have using futures position, but it consists of options. For example, you could, as we do in the Slingshot, one of the applications, we could do like a combination of buying some in-the-money calls, at the same time selling some at-the-money calls, having a net delta of about 100, which would be the same as if you would have bought the market and having 100 delta. But we now have, from that second onwards, a known maximum risk, because the most we can lose is the premium we paid. So it's pretty simple. And it basically avoids dramas. In other words, it avoids big losses. And in the trading that I do, it's all centered and focused on risk management. In other words, what is really critical is trying to avoid what I call volatility drag. Volatility drag is a concept which is used by market makers and prop traders, which basically says, well, if you lose X, you have to make up more than X. In other words, you lose 20%, your account goes from 100 to 80. Now, if you make 20%, you're not back at 100, of course, because you'll only be at 96. So you have to make up 25%. If you lose 50%, you have to make back 100%, and so on. So the bigger the volatility, the bigger the drop, the bigger the drawdown, you have to make even more to come back to break even. So the simple way to avoid these kind of dramas is to have a very low maximum drawdown. In other words, if you have only a 10% maximum drawdown, you only have to make back 11%, you will be back at 100%. If you would say 50%, you have to make back 100%. So for that simple reason, the focus is really on risk management, on risk control.
Makes sense. Can you pinpoint any key breakthroughs that helped you become more consistent or kind of aha moments, especially when you were younger in your trading days?
Yeah, good question. I think the one of the key things is that I wanted to avoid falling into that trap of optimal or try to come up with, say, the best system, the best backtest. It's really the wrong method. So when you say, well, I need to find something which is not optimal, but it's probably then by definition suboptimal, but you try to find some kind of a plateau. In other words, even if the market changes, even if the strategy is not perfect, just go with that and try to be, say, satisfied with the fact that you have found a decent strategy, which is delivering a decent return. Not probably the best, because the best would assume that if you look at these back tests or historical testing of your strategy, and you say, well, I need to fine tune these three inputs. And if I take 5, 17, and 21 for these three inputs, I have the optimal, the best backtest. Well, it doesn't help you. Why not? Because it would only help you if the future would be an exact replica, an exact copy of the past, which it never will be. So it doesn't really is a good thing to try and optimize systems and try to fine tune them to the extent that they seem to be able to now produce a marvelous return with an extremely low drawdown. It's simply not possible for the simple reason that it would assume that the future market behavior would be an exact copy of what you have just tested on. So by going for the more simple route and trying to not try to find the optimal selection of inputs, but rather going for a plateau, as I call it, you basically come out with a robust system. So something which is really stable and will be able to provide you with consistent returns over the years. And that's basically, I think, one of the bigger breakthroughs or aha moments that convinced me. Because if I go back in time and say, well, in the early 90s, we were playing along with neural networks and fuzzy logic and all these kind of algos which were fancy back then. And it turned out to be a very big exercise in curve fitting with hidden layers and input layers and feedback layers. And all these neural networks looked perfect on paper and in historical testing, but didn't really work in practice. So it had to do with the fact that it was like a huge, even hidden curve fitting exercise, because you don't know what's basically in between these layers, between the input and the output layer. And so you end up with a very complex system. You don't know exactly what is going on behind it in the machine. And you just hope that it's going to be similar to what you have seen in the tests, but it doesn't. So by simplifying things and having or using simple concepts like key area of support resistance, when the market is really taking off, it's really changing its behavior. That's, I think, the main driver for generating or coming up with a decent system.
Yeah,
So simplicity above all.
And one thing I noticed when I built the trading simulator is if you have a system that's okay, but kind of a rough equity chart, and you combine it with multiple copies of it, so you essentially have multiple systems working together, and they're all kind of okay, but they're not the greatest. The equity curve, the growth curve, is very smooth because it's like with your system, one's long, one's short, another one's long, another one's short, but they all average out and they're all making some money. But the combined portfolio growth is not very it's not very not big deviations from that growth. You don't have big
Absolutely,
losses or big
absolutely.
gains.
That's exactly right, because it's really the advantage of the fact that you're using different systems, different approaches, which have, of course, a correlation which is not one. So it's going to be below one, and the fact that it's not perfectly correlated, they're going to do something, they will be doing something different. And by the fact that they are doing something different, it will help smoothing out the equity curve, and so making it less jagged, and so with drawdowns which will not be as steep, with rallies, of course, which are not going to be that steep. So you're basically improving on your risk-adjusted return ratios, be it Sortino ratio, be it Sharpe ratio, or Ulster index, and so on. The one I prefer to look at is the ratio between, say, the CAGR, so the compound annualized geometric return, and the maximum drawdown. Why maximum drawdown is for me like the key indicator for risk, because standard deviation is one thing, it's volatility, standard deviation of returns. But of course, if you have a system like mine, for example, which is flat sometimes for weeks in a row, and then suddenly has a jump in the right side, so to the upside, it will basically get penalized. Why? Because the volatility is high because of the positive surprise. So while volatility measures the deviation from the regression, it's not going to make any difference between positive months or positive weeks and the negative ones. So they all are bundled together. So in the Sortino ratio or in the maximum drawdown, of course, you look only at the negative events, which is basically a better way to looking at risk. And so if you combine this Sortino ratio and maximum drawdowns, and you compare that to the annualized geometric return, then I think you have a pretty good measure of how valuable your strategy is. Because I've seen over the years that some of the better systems with, say, Sharpe ratio are not necessarily better than those with a very decent reward to risk ratio, reward being the annualized return, risk in my definition being the maximum drawdown. So the maximum drawdown is for me like the key feature, and that's why all the risk management is focused on that. So trying to avoid this famous volatility drag, trying to avoid deep drops, steep drops in the equity curve. And then I think the returns are like a byproduct. If you manage the risk well, if the strategy is decent, it doesn't need to be superb. You will come out ahead because you won't ever have very deep drops in the equity curve.
Right. Okay. Do you have any tips you would give someone who's just starting out with trading or especially option trading?
Well, I think the best advice I would give is try to keep it very simple, because it's very tempting to come up with very complex trading strategies, especially when you're using derivatives like options, that it becomes really very complex, hard to understand, and difficult to decipher what is really causing what. If you would have, say, a structure with 7 legs and with 2 or 3 different expirations in the strategy, it becomes extremely confusing. So that's why I always try to have different bundles of option legs, which are, for example, using the same expiration date, or which are not too different one from the next, just to avoid that I can't see basically what is causing what. So a simple strategy basically is what would be the best for people starting off with derivatives.
On I saw you posted a chart in your Slingshot Trade Alerts today, so that was great. I think it'll help your subscribers, but as far as any charting recommendations, time frames you recommend for people, especially when they're new?
Okay, well, I think it's good to have like multiple time frames to basically look at the bigger picture. And bigger picture, if you're a short-term trader like I am, it could be like looking at the 4-hour chart, the 30-minute chart, the 5-minute chart, so that you see, well, the overall trend is bullish or bearish. And so then let's try to go with the trend, especially when you're doing, of course, trend following. If you're doing contrarian approaches, of course, it's a different story. But I would start with a couple of time frames, look at these, and make sure that your shorter term trading is in line with, say, the longer term trend. That's the easiest way to start off, I think.
Makes
And
sense.
of course, then later on, you can experiment with other type of time frames, such as tick charts and raincoat charts and all these kind of things. But that's more complex, and it has all kind of like hidden disadvantages. For example, when doing back tests, it becomes very tricky with, for example, raincoat bars or tick charts. because you don't know when basically a new candle is being formed and so on. So that's more complex. So I would definitely start off with simple things like hourly bars and 15-minute bars and 5-minute bars, and look at those. Try to come up with a decent support and resistance schedule, and that's probably a good starting point.
Yeah. Well, thanks very much, Luke. We're about half an hour or so, so I don't like to go too long. Um, but
Perfect.
but really appreciate you coming on, and congratulations on the launch of your new fund. Uh,
Thank
Luke
you.
does Luke does have a trade alert service with Aeromir, the Slingshot trade. So I'll put a link to it with the recording, and it's got pretty good results. I think what were you up in May is some huge number. Like it was double digits.
Yeah, that happens occasionally.
Yeah,
Not all the time, but
not
occasionally you have
every
these.
month.
No, no, no.
Yeah. All right. Well,
Super.
thanks so much.
Okay.
Really
My
appreciate it,
pleasure,
and
Tom.
I'll let you get back to the markets.
Okay. Thank you, Tom. All the
All right.
best.
Thanks,
Thank
everyone.
you.
Yep. Bye.
Bye bye.